I want to talk about one of the great myths of our times, which is that the City of London is the beating motor at the heart of the UK economy, and without it, we are in a right mess. I'm going to say the exact opposite. The City of London is a disaster for the UK economy, and the quicker we take action to curtail its activities, the better. I'm going to talk a bit about my background, so you know who I am, why I'm here, and so on. But I'm here today not to talk about tax havens, which has been the subject I've investigated since 1978. I'm going to talk more generally about how financial capitalism has morphed in the last 40 years into something so destructive that it is actually destroying our economy and the world as well. I want to take you back to January 2007. The Today programme, John Humphreys was interviewing someone called Richard Lambert, who at that time was the head of the CBI, former editor of the Financial Times, a true believer in neoliberalism, and I was sitting opposite Richard Lambert as the discussant. And I've been saying for some time, much to the contempt of the BBC, that Britain in 2007 was heading for a financial crisis, and that financial crisis was hidden in all sorts of debt instruments, and that the only thing we could do was to instruct the regulators in London to massively strengthen regulation of the City of London in order to curtail the wild trading activities. Richard Lambert took the exact opposite view. He said, as you might expect, what the City of London needed was a light touch regulation, more tax cuts to make it competitive. You probably hear that all the time. You've heard that from Ed Balls. You've heard that from many other people. That word competitive is a very interesting word for an economist like me, because it is complete balls. If the City of London wants to compete globally, surely it should set its fees lower. It has the highest fee rates in the world. Or it should improve the quality of the services it provides. It doesn't need to have government subsidies, tax cuts, and so on. That's not the way you create a competitive market. And yet the language that's fed through into the New Labour project, which I was quite critical of at the time, was that in order to maintain London's competitiveness, we must cut taxes, we must cut regulation, we must subsidise the City of London. My core argument, which is now gaining strength, I think, across the world, is that far from being the goose that lays the golden egg for the British economy, the City of London is something of a cuckoo in the nest. And on that Today programme, I said that we now need to move towards a very different era in which we take radical steps to block the speculative activities, particularly the short trading the City of London specialises in. We need to take radical steps to tackle the tax avoidance, which is the core of so much of the City of London's model, particularly private equity models. We must take radical measures to cut back on London's role as the most prominent money laundering centre in the world. We should introduce financial transaction tax and a whole host of other regulatory measures. And that if the City of London wants to continue to compete as the world's largest offshore financial centre, it should do so on the basis of competitive fee rates and competitive quality of service. So I present to you two very contrasting views of how we can reboot Britain's development strategy, because from 1956 onwards, and I'm very specific about 1956, that's the time when the euro market was established in London, and London started to become the world's largest offshore financial trading centre. From 1956 onwards, we have been making major concessions to the City of London to the disadvantage of the rest of the world. And that has created a political economic phenomenon known as the finance curse. That's what I'm here to talk about tonight. Just a few quick words about, first of all, my background. As you heard a few minutes ago, I'm an economist. In 1978, I started to investigate offshore financial centres and in particular Britain's offshore financial services centres. I now chair the board of a global network of academics, professionals, called the Tax Justice Network. We are the beating heart of the global tax justice movement. If you're not familiar with the Tax Justice Network, you're certainly familiar with our work. We were at the core of the Panama Paper investigations, for example. We were at the core of the investigations into Starbucks, Google, Amazon, and all of the associated players, Facebook, their tax avoidance scandals, and so on. At the heart of my thinking, and I think the network's thinking, is that tax is a very, very important and powerful tool for shaping economic development. And therefore, any prospective government that wants to reboot the UK's economy needs to rethink its policies on tax fundamentally. The core of the argument for the last 40 years is we must cut taxes to be competitive. I think the exact opposite. We must tax better in order to create a more competitive environment, which means better research, better infrastructure, better training, all the things that are needed for a modern functioning economy, and where we've been falling behind for many years, leading to a very rapid fall off in productivity. I'll get back to productivity in a few minutes' time. For those of you who are interested in my research into tax havens, I recommend this film, which I co-produced, which came out in 2017. It's now available on YouTube. It's been watched by well over 2.5 million people since it went up on YouTube 12 months ago. And this film is a kind of deep exploration of how, since 1956, since that moment when the Bank of England very surreptitiously gave the nod to Midland Bank, remember Midland Bank? That Midland Bank could start trading in dollars in London outside the regulatory overview of the Federal Exchange, but not regulated by the UK regulators, because the UK regulators only regulated sterling deposits. And in doing that, created an offshore unregulated market, which very quickly grew to first billions, then trillions, now the biggest financial market in the world, and which, first of all, attracted billions of dirty money. It's very rapidly spread out of London as the big banks and big trading houses moved to Jersey, Channel Islands, Cayman, Bahamas, and have created what we call Britain's spider's web of tax havens. It sucked in money from all over the world at a time when sterling was weak, but it actually achieved a very negative outcome over the long period, because certainly for the last 50 years, sterling has been overvalued as far as UK manufacturing and UK productive industry was concerned. And this overvaluation of sterling, this sucking in of all those hundreds of billions, indeed trillions, created a situation known technically by economists as the Dutch disease, where the more the money flowed in, the more sterling became overvalued, the less easy it was for UK manufacturers to export. In fact, it made exports relatively less competitive and imports relatively more competitive. And at some stage, it seemed to me it was sometime around 1979, 1980, the incoming Thatcher government decided it was no longer that interested. Britain no longer had a future in manufacturing. Our future lay with the city. And slowly but surely, that led on to 1986 and the Big Bang. And from then onwards, government policy was mainly geared to sustain the competitiveness of the City of London. And this has had disastrous effects. I'm going to talk about that. It's led to financialisation of the UK economy. I'm going to talk more about what that means. It led to London becoming the global centre for most acquisitions. Governments, successive governments, including Tony Blair, boasted about how much inward investment was being attracted to the UK. Far too much of the inward investment coming into Britain was not actually real foreign investment. It was UK capital that had been shifted offshore to the Cayman or to the Channel Islands and came back onshore, dressed up as foreign direct investment. And huge amounts, huge sums of that didn't go into new investment in productivity. It came back either into real estate, and we can look at the figures later if you want, or it came back into mergers and acquisitions. And through the 1980s and 1990s and beyond, London was mergers and acquisitions central, buying up successful little companies and gradually merging them all into monopolies. And if you look at our high streets today, nothing but monopolies. You can look right away across the UK economy, and we have turned our economy into, we're not saying the United States and many others, monopolies prevail everywhere. So we're at a very interesting inflection point because John McDonnell, who I've worked with since 2003, he's very conscious of the political power of the City of London. He's also very conscious of the fact that the City of London is not delivering the kind of financial services that we need, which is one of the reasons why he talks about us needing regional development banks and a national development bank, precisely because the private sector banks are not geared to the kind of investment you need at regional and national level for the big projects that we need to undertake, including climate change mitigation. They're much more geared to property development, funding mergers and acquisitions, and frankly, funding speculation. But he's not alone in this. Here's a predecessor, Clement Attlee, saying, we have in this country an extraordinary power, which is by and large able to overrun democracy in this country. That's been my experience and my observation of the last 40 years of working in and around the City of London. They are totally subversive of democracy, and it's clearest in the way in which they think that tax avoidance is a perfectly legitimate activity, which of course it never is and never was. Contrast that position with the position of the former mayor of London, I don't know whatever happened to him, who boasted at the time of the financial crisis that he was the only politician in Britain who was still prepared to champion the interests of bankers. And he spent a great deal of his time, when he was mayor of London, in Brussels, which is where I was for much of my time. And I was being told by one politician after another in Brussels that, oh yeah, we just had Mr. Johnson and his entourage, and they are pushing back very strongly against every single attempt by the European Union, particularly by the Parliament, to successfully regulate financial services, so we didn't have a repetition of the great financial crisis. They were pushing back against financial transaction taxes. They were pushing back against attempts to regulate short trading. They were pushing back against every single attempt to curtail tax avoidance. And it was no coincidence, as far as I'm concerned, that by 2013, 2014, about that time, all the City of London lobbying had failed to block the European Union's tax avoidance directive, which came into force this year, that at that stage they decided to take a very different tack indeed. But if you look at Johnson's position, and particularly the position of his Chancellor, Mr. Javid, who you will remember is a former Deutsche Bank wealth manager out of Singapore. That's where he worked, that's where he made his money. In other words, he's an offshore guy living in an offshore world. The development strategy they're proposing comes under the term Singapore on Thames. I'm sure you've heard that term. Singapore on Thames is very clearly a strategy aimed at doing three things. First of all, cutting taxes on capital significantly further. In fact, they want to abolish the corporate income tax entirely. I've had discussions with them about that. For those of you who don't know about tax, the corporate income tax is not primarily intended to raise money, though it does raise a bit of money in this country. It's primarily intended to underpin the personal income tax. The reason for that is because the richest people in this country, let's say the top 1%, generally don't hold their assets in their own name. They hold their assets in corporate or trust form. And if you abolish the corporate income tax, you're effectively removing them entirely from the tax bracket. So that's why they are so keen to do two things: abolish the corporate income tax and As of yesterday, I read the Brexit Party's plan to entirely abolish inheritance tax. The elites are very happy about that. So I think we can all accept that the City of London is the world's leading offshore financial centre. Its cheerleaders claim that the City of London is a major contributor to the UK economy. I'm going to argue exactly the opposite, and I'm going to give you some research which we produced last year, or rather which we commissioned last year from a specialist team at the University of Massachusetts. But, and this is the big but, all the evidence coming out of the International Monetary Fund and the Bank for International Settlements suggests that once your financial services sector grows beyond a certain size in the economy, far from actually helping with wealth creation, it starts to do something very different. It starts to extract wealth from the economy. It extracts wealth in a multiplicity of different ways. Now, first of all, what is that point where it moves from being part of the creative economy to being part of the extractive economy? IMF puts it at about 90 to 95% of national income. So if your gross domestic product is, let's say, $1 trillion, if the debt in the economy is about 90% of $1 trillion and 900 billion, then you're more or less at what the IMF think of as an optimal point. To give you some idea of where we are at the moment, it's 260% of national income. And at the time of the crisis, it's slightly below that. What's happened is that we've moved from a financial services sector that's geared to supporting productive activity to a sector that extracts in the form of, well, in a variety of forms. One of the most obvious is the private finance initiative. You know, that bargain where you can get one hospital for the price of 3 and stuff like that. It's moved to the point where inward investment is not going into new greenfield productive activity. It's going into mergers and acquisitions, creating monopolies. And those monopolies then start to extract what economists call rents from the economy. It goes into private equity buyouts, which is just one gigantic scam. It goes into encouraging massive mortgage debt, speculation, currencies, etc., etc. All of these are what happens when the finance sector is allowed to become oversized. Now, I mentioned that I headed the Government Economic Service in Jersey for 10 years, specifically from 1987 to 1998. And whilst I was there, the top line of my job description was to maintain a balanced and diversified economy at a time when Jersey was going full speed ahead with becoming a full-on tax haven economy. And my job was an impossible task because the finance sector was literally destroying the rest of the economy through inflationary pressures, through bidding all the brightest and the best young people away out of real entrepreneurial activity into banking and so on, offshore banking. So much of my thinking around the finance curse stems from my work in Jersey, but I always thought that Jersey was quite simply a microcosm of the wider UK economy, and that's exactly how it's turned out. I think that Britain shows all the signs of being, if not the biggest, certainly one of the biggest, I think it's probably the biggest economy in the world, which is essentially completely crippled by the finance curse. And whilst the southeast where I live has fared reasonably well, I think it's massively impacted the rest of the economy, and I'm going to put a figure on that later on. And this is the crunch point, why the coming election is so important. If we move in the direction of Singapore and the Thames model, in other words, a massively deregulated economy, where most social protections are quite simply abandoned, most environmental protections are simply abandoned, most workers' rights are simply abandoned, and taxes on capital are almost entirely cut, then not only are we going to become a very much more unequal and slower growing economy, but we're going to become an economy where the politics will inevitably fail. I think we've seen signs of that already around Brexit, because whilst capitalism used to be quite compatible with democracy, it's going to be very difficult in the coming years to sustain democracy in a country that's divided, as we will become if we go down the Singapore and Thames route, which is my cue for this morning's Financial Times. This is the front cover. Capitalism, time for a reset. Might not be aware that the lead economist, Martin Wolf, is probably regarded as the world's most important economic commentator. And here's what he wrote in today's FT. The title of his article, by the way, is Why Rentier Capitalism is Damaging Liberal Democracy. The level of financial development is good only up to a point, 95%, after which it becomes a drag on growth. And that a fast-growing financial sector is detrimental to aggregate productive growth. In other words, pure finance curse. And for what it's worth, at the end of last year, when we published our book on the finance curse, Martin Wolf nominated as one of the top 10 books of last year in the FT series. For those of you who are not familiar with the economic term rent extraction, here's a very quick definition. In the 19th century, all the economists, the political economists, Adam Smith, David Ricardo, Marx, they all, and Keynes for what it's worth, they all well understood the danger of allowing an economy to become a rentier economy. Rentiers use ownership, possession, or control of assets that are scarce or artificially made scarce to extract wealth and income. This rent-seeking activity reduces the efficiency of resource allocation, lowers investment in genuinely productive activity, in wealth creation, in other words, harms tax systems, and increases income inequality. You're not going to find many economists, either on the left or on the right, who would disagree. This is an area where most economists, real economists, are totally agreed. So you're familiar with classic examples: rent income, land, property, mineral exploitation, financial investments. But there's also the way in which monopolies can extract above average profits. Income from debt interest on public investment, private finance initiative. Remember, one hospital for the price of 3. Income from subsidies, tax relief, special tax treatments and tax avoidance. A large part of the lobbying that goes into politics in the UK in the last 4 years has been around getting these special tax treatments. National Audit Office currently recognises just shy of 1,400 tax reliefs for businesses in the UK. Now, I and virtually all other economists I've ever met say these tax reliefs are worthless. Because if a business is actually profitable, it doesn't need tax reliefs at all. It's money thrown away. Current cost of those tax reliefs, something like 120 billion a year. Thrown away. Most of us would have thought when we buy a train ticket that there'll be a company behind it, it's called Trainline, and that company will probably make a little bit of profit from the 75 pence it charges to us when we buy a ticket online. The real cost of actually transacting that purchase on your behalf is probably something in the order of 3 pence, possibly 5 pence. We can't quite determine it. But you'll charge 75 pence. Now that's an extraordinary profit by any means. But what's really extraordinary about Trainline is its ownership, as you can see here. And we're not showing the full ownership thing. What we're showing is that the Trainline.com Limited, where you buy it from their website, belongs to Trainline Holdings Limited, registered in the UK, which belongs to Trainline Group Investments Limited, which belongs to Trainline Junior Mezzanine Limited, which belongs to Trainline Investments Holdings Limited, which belongs to Victoria Investments Newco Jersey Limited, which belongs to Victoria Investments Bigco. I can go on and on and on and on. In other words, Trainline is not a simple, straightforward single company, and ultimately it belongs to a gigantic private equity company, KKR, the largest in the world, based in the United States. All of those extraordinary profits that it's making from your 75 pence, multiply that by 10 million a day, and you can start talking serious money. All of those profits are extracted out of the UK economy and disappear offshore to the offshore structures in Jersey, Luxembourg, and there was some other tax haven. I think there's Delaware in there somewhere, possibly Ireland as well. But ultimately, this is just a machine for sucking money out of the UK economy what economists would call monopolist rents. You can apply that to so many other case studies. One of my favourites, which was published on the front page of The Guardian in November 2007, I worked on this story with The Guardian newspaper, involved bananas. Because we showed how bananas traded into this country, highly profitable fruit, by the way, extraordinary profits made there against global monopolies, 4 big trading companies, Dole, Chiquita, Del Monte, and East. All of them using offshore, and all of them had created extraordinary structures to extract wealth out of the producer countries and out of the consumer countries. And just short of half the price you pay for bananas in the shops here ends up as extraordinary profits booked into tax havens offshore. The entire globalized economy is now structured in these sort of ways. Trainline is not an exception. This is the way that modern economy works. And it works because we've allowed these companies to create these structures within the permissive rules that have been created and which continue to shape the globalized economy. You don't need me to tell you that we've become a great deal more unequal. This chart, UK is second from the right, and what this is showing is how the top 10% of income earners in the UK and in other countries, how their share of income has increased between 1981 and 2008. And what you can see is that the UK and the US, inequality has increased faster in these countries, both of which have pursued very similar development models. And if we look at productivity, the UK fares even worse. Not quite as bad as Italy, but if we look at how productivity has moved since the 1950s and the 1960s, we saw an astonishing growth of productivity right the way across the Western world. In the 1950s, in America, it's called the golden age of capitalism. In France, it's called les Trente Glorieuses, 1950s, 1960s, 1970s. Most people experienced an astonishing improvement in their qualities of life, their standards of living, incomes went up. More generally, economic growth was sustained at very high levels compared to the last 40 years. The last 40 years have had much lower rates of growth, and that's not coincidence. 40 years ago, Mrs. Thatcher introduced neoliberalism to this country, and Ronald Reagan introduced neoliberalism to the United States. Neoliberalism boils down to 4 key measures. One of them was liberalization of financial markets. We abandoned capital controls and allowed capital to flow anywhere it wanted across the world. And we did that without a framework of rules for taxing capital, particularly the big multinational companies. The second one was trade liberalization. I'm not against trade liberalization, I'm not indeed against financial liberalization, but doing that without having the safeguard that rules allowed nation states to continue to tax capital and to regulate capital was a major mistake, and one which they're only rectifying or starting to rectify now. And they're starting to rectify it mainly because the Tax Justice Network has been pushing for some of these specific measures that are needed in this area. But the UK comes out very particularly bad, not quite as bad as Italy. The UK is particularly bad in this respect for a number of reasons. One of which, of course, is we allowed UK capital to start flowing anywhere in the world, and it very quickly did start flowing everywhere across the world rather than investing in this country. We saw our manufacturing disappear. We also saw a rapid cutback in research and development right the way across all sectors. And we're now seeing the legacy of that, because whilst we do have very high levels of nominal employment at the moment, historically high levels, you don't need me to tell you how much of that labour is in fact underemployed in the gig economy, part-time contracts, in many cases, people working to qualify as employed. You, as I understand at the moment, need only work more than over 1 hour a week, which is not my idea of employment. So the statistics tell a very weak story, but productivity in the UK has fallen dramatically, and that's partly because we have moved so fast away from manufacturing, high-level engineering, and other activities into relatively low productive activity. You know, very rapid growth, people working in catering and hospitality sectors, where productivity rates are generally very low indeed. So this chart comes out of the United Nations Human Development Index, and it's looking at what are called, in United Nations terms, the high-income countries. You see that line down the centre there? The UK is on the left-hand side of that line. The line is an indication of national income in the context of human development. For high-income economies, it's saying how successful are they at translating all that GDP, gross domestic product per capita, into human development, education, health, absence of crime, all of these things. They take a whole range of different indicators and say which countries are successful at doing this and which countries are not successful at doing this. Sadly, Britain falls on the wrong side of the line. We are amongst the more unsuccessful countries when it comes to turning our gross national income into real human development. And there's a pattern here, and the pattern's shown by yellow and red. The countries which are yellow, towards the bottom, they are largely petrocarbon countries. Think of the Middle East, Nigeria, and so on. Very high rates of extraction of oil and gas, very poor at converting that oil and gas into human development. That's called the resource curse. The red countries are the finance curse countries. These are the countries where they have an oversized financial services sector, according to the IMF. And again, you see a pattern of being relatively unsuccessful at turning all that wealth, the trillions flowing through London, trillions daily, I should say, into human development. In fact, across a whole range of human development indicators, infant mortality, poverty, inequality, and so on, we perform remarkably badly. And we shouldn't. I'd like to say that Britain should be up there at the top. It clearly isn't. And I argue that this is largely because we have allowed the oversized financial services sector to shape or misshape our economy in a whole host of ways. One of those ways being, of course, the way in which the City of London specialises in extraordinary sums of tax avoidance. For those of you who don't read the Daily Mail here, we don't often find ourselves on the front page of the Daily Mail, but earlier this year, this is in May 2019, the Mail actually ran a full story about our new corporate tax haven index. It's an index looking globally at countries across the world and saying which are the countries which are most aggressive in helping multinational companies to avoid paying tax. And it won't surprise you that Britain and its spider's web, the archipelago of islands, Cayman Islands, Bermuda, Channel Islands, Isle of Man, Gibraltar, etc., Britain comes out at the top. And I think that's actually been the root of our development strategy. We have allowed a tiny elite to shape an economy which meets very much their needs. And look at the big multinational companies that fund the political parties in this country, particularly the Tories, and you'll find that many of them are deeply embedded in offshore. We've dug deep into party political funding, and you'll find, for example, that over half of the Tory party's funding comes from offshore sources. And it says something about how we need to reform our democracy in order to make party political funding perhaps a little bit less secretive and a little bit more democratic. But look at our newspapers. How many of our newspapers belong to billionaires, all of whom are offshore? I come from the Channel Islands, as you know, and I can wave at the Barclay brothers from outside the bedroom window, but they're the Barclay brothers who own the Telegraph. They're embedded in the Channel Islands, deeply embedded in tax avoidance. Desmond, when he owned the Express Group, he operated out of Jersey. Murdoch, full well how he operates. And Rothermere, owner of the Daily Mail, is, of course, for some reason classified as non-domiciled in Britain, has non-domiciled tax treatment. So he moved to France for a few weeks. But look also at how the BBC, for example, draws upon commentators. And I've been running a campaign now for 3 years, successfully, I'm glad to say. Now, we've been challenging the BBC on its choice of commentators. particularly economic commentators, they regularly bring in the Institute for Economic Affairs. Anyone ever heard of the Institute of Economic Affairs? Kate Andrews, yeah. They're all the time, but they're also funded by tobacco, they're funded by oil, they're funded by pharma, they're funded by American private health insurance companies. They don't reveal that. They're not a think tank, they're a lobby organisation, but the BBC present them as independent commentators. We challenged them, and the BBC is now reviewing the entire policy. Same with the Adam Smith Institute and a whole host of other nominally, they call themselves think tanks. But my view is that it's bad journalist practice to not know who you're dealing with and to not state who you're dealing with. So if you're dealing with a lobby and you don't reveal it as a lobby and you don't reveal its funding sources because they refuse to reveal their funding sources, then you should never have them on the BBC. Simple as that. It's corruption. We all know that the City of London is a state within a state. We also know that our banks, particularly HSBC and others, which are criminal banks, are too big to fail and too big to jail. And if you speak French, not the last film I made, but one before, is called HSBC, Les Gangsters de la Finance. And I can say they're a criminal organisation publicly without any fear of libel because it's there in the courts. And we don't prosecute them. The United States prosecutes HSBC, or intended to prosecute HSBC until our Prime Minister at the time, David Cameron, went across to Washington, begged them to not prosecute HSBC for money laundering. For those of you who haven't followed that case, it's quite extraordinary, because the subpoenaed evidence presented to the Department of Justice shows that at one time, a branch of HSBC in Mexico widened the windows of the tellers in the branch. And it was revealed in court that the reason for widening the teller's windows was to allow larger suitcases of cash to be passed through the teller's windows. You couldn't make this stuff up, it's there in the deposition to the court. So, to the nub of the Singapore-on-the-Thames model, if after the next election Mr. Johnson forms a government, that's what they're committed to. And when you talk to their advisors, and some of the economists around them, they'll say, well, actually offshore finance is very successful. Look at the figures. Look at Liechtenstein, look at Luxembourg, look at Jersey. At face value, turning your economy into a tax haven sounds like a really good development strategy, but the figures are not what they appear to be. For a start, if we take Jersey, GDP per capita of $57,000 is complete rubbish, because that includes all the profits being booked by offshore companies in the island, which never actually touch the island's shores. Remove that and the figures collapse entirely. They're totally misleading. And the same applies to the UK. So many of the measures that we've adopted in recent years have been designed to help multinational companies book profits in the UK, which are then distributed onto shareholders elsewhere. In most cases, not even touching UK shores. I challenged, as economic advisor to the government of Jersey, I challenged the very idea that this was working for Jersey because I saw very different phenomena. What I observed whilst I was in Jersey, and subsequently I still go back regularly, really strong inflationary pressures because of all that money sloshing through the economy, the overriding scale of the banking activity, the huge bankers' bonuses all flooding into the local housing markets, or flooding into the local restaurants. Jersey literally killed off all of its other industries, crowded them out. Also, massive economic volatility. What happened in Jersey was totally dependent upon actions all over the place. In 1998, for example, during the crisis that began in Far East Asia and then moved across the world, Jersey's economy dipped massively as a result of that. All of the brightest and best in Jersey went into banking and accounting and legal, paralegal services, rather than into creating their own businesses and engineering and so on. The island very quickly turned its workforce into a, by and large, what I would regard as a clerical service workforce, and that created problems of skill shortages in all the other sectors. So the light manufacturing sector simply disappeared, and my job was to try to maintain the light manufacturing sector. But all the young people who wanted to go into apprenticeships went to the UK and stayed in the UK or went elsewhere. And that created something called path dependency, a phenomenon that all economists recognise. Once you've lost your skills, the skills in your economy, then you have a real problem because skills take several years to build up, which is precisely where we are now in the UK. We have such severe skills deficiencies right the way across most sectors. Where do we get those skills from? It takes, 5, 6, 7 years to go through a full apprenticeship and become a fully skilled engineer. We end up becoming very dependent upon migrant labour to fill those gaps. And that was the case in Jersey. We then found ourselves over-dependent on financial services, which meant, I wonder how often you've heard this on the Today programme. Do you listen to the slot from 6:15 to 6:30? That's when you hear the bankers coming on saying, well, if you don't deregulate, if you don't give us lower taxes and so on, we're out of here, we're going to go to Dublin, we're going to go to Luxembourg. HSBC played that very successfully with George Osborne. They said, if you try to tax us or try to strengthen regulation, we will leave. And I said, where are you going to go? We're not going to go back to Hong Kong. You're going to go back to China? Ain't going to happen. George Osborne caved. HSBC stayed. And that's called state capture. You see an increase in rent-seeking behaviour and the loss of entrepreneurialism, state capture, rising corruption. These are all the things, this is the bundle of things that make up the finance curse. Just to illustrate that, you all know that house price inflation in the UK took off really heavily in the 1980s. I used Nationwide to show this chart, starting at 100 in the UK. I looked at 25 years. The reason I did this was because I actually established a very similar house price index in Jersey. There wasn't one there before I took over the Government Economic Service. But look at the rate of inflation in Jersey compared to the rate of inflation in UK over that period. Jersey house prices actually moved very rapidly and are now more or less in line with central London prices. Now, how can you run an economy with a tourism sector, an agriculture sector, a horticulture sector, and a light manufacturing sector when your house prices are that high? Your young people simply can't afford the rents, they can't afford to buy, unless daddy's very, very rich or mummy's very, very rich. So what they achieved there was they simply killed off the rest of their economy. And this chart shows exactly that. Comparing 1970 with 2013, what you see in 1970 was a dominant tourism sector. You might remember Honeymoon Island, bloody blah, almost disappeared now. Tourism from over half to 4%. Financial services, under 10%, 9% exactly, to 42%. That's the extent of the growth and the crowding out. It simply killed off all other sectors. Many of the other sectors that still survive, agriculture, 2%, to be honest, without subsidies, it would be dead. Retail, manufacturing, 1%. Most of the other stuff is construction activity, public services, and so on. So you can see an economy that's become essentially dominated by a single sector, with all that implies. But the UK is not that different. This chart, which comes from the IPPR, the Institute for Public Policy Research, it looks at a period, 1992 to 2012. So we're talking here about a 20-year period, and we're looking at annual average sectoral growth rates. Manufacturing shrunk by almost 3% per year over that period. There's our productive economy. Mining and quarrying, agriculture, forestry and fishing. On this side, look at the big ones. Real estate activities. Well, that won't surprise you, will it? Well, the house price inflation. Professional, scientific and technical activities. Unfortunately, that one is very largely actually accounting and associated business services. And insurance activities. But the astonishing thing actually is that investment in those sectors and employment in those sectors really hasn't grown. What has grown is the wages and earnings in that sector. But what you see there is the very quick transition away from productive activity towards what I would regard as largely service-based extractive activity. Not entirely, but largely. And I can bring it up to date. I've got a more recent chart here. The big ones here are auxiliary finance and finance. That's interbank lending. And look how huge that is. real estate here, agriculture down here, manufacturing there. In other words, an astonishing tale of weak to low investment in productive activity and a great deal of trading in finance and real estate. And this is the boom moment when we look at the bill. I mentioned earlier that we commissioned the University of Massachusetts as a special team at the Political Economic Research Institute there. They measure macroeconomic underperformance. They specialize in looking at the financial services sector. We asked them to replicate something they did for the US economy in 2016. In 2016, they looked at how, as an outcome of the great financial crisis, how much Wall Street had undermined potential growth of the US Main Street economy. And they came up with a figure of 22.7 trillion US dollars. Now, a trillion, for those of you who don't get bank bonuses, is a million. So 22.7 million dollars underperformance as a result of three factors. Factor one is what's called misallocation costs. Banks are supposed to specialize in allocating capital to where it can be used productively. They're not doing that. Instead, they're allocating capital to where it can extract wealth from the economy through speculation and so on. Then the overall rate of growth for the rest of us is going to be lower. In the case of the UK, they reckon that between 1995 and 2010, misallocation of resources by the City of London cost us £2.7 trillion in underperformance of the economy. So just to repeat, that's 2.7 million. And then there was the cost of the bailout and the cost of the financial crisis, which has certainly set the UK economy back massively. They put that figure at 1.8 trillion, 1.8 million over that extended period. There is a further cost, which is the monopolist position where they can overcharge borrowers of money. But since such a large part of the money that flows through the UK economy is actually offshore, that's not specific to the UK economy, so we'll discount that. We settled at 4.5 trillion, that's 4.5 million as a result of hosting an oversized financial services sector in the UK. That's what it's cost the rest of the economy in underperformance of the economy. I'm going to wrap up now because I hope I've generated enough interest for you to start raising some really good questions and so on. The good news is, and I think this is good news for any new government that's not committed to the Singapore and Thames model, is that if we're correct in our finance curse hypothesis, the solution is really simple. If we have an oversized financial services sector, and that financial services sector is not actually doing what it should be doing to promote wealth creation within the economy, then you simply cut it back to size. And there are two ways of doing that. You regulate it and you tax it. And that's precisely what John has implemented or will be implementing in the 2019 manifesto, a massive shift away from the light touch regulation of a low tax model, because I'm not in favour of high taxes for the sake of high taxes, but I'm very much in favour of taxing monopolist rents wherever they go. Most economists would say you can tax monopolist rents to 99% and monopolists will continue to operate. I'm not talking about 99% tax rate. But it's time for us to face down the city's bluff. The city has said for a long time, if you try to regulate us, you try to tax us, we'll leave, we'll go to Luxembourg. The best reply is bye-bye. Because trust me, capitalism works as follows. If there's an investment, a profitable investment to be made in the UK economy, in productive activity, they will make it. The trouble is we do not currently have a banking sector that's fit for that kind of purpose. For those of you who want to take a more academic route into this, there's an academic paper which was published, peer-reviewed and all the rest of it. I think it's available, I know it's available free online, so you can read more about it, published with Nick Jackson, the journalist I've worked with for the last 10 years. Duncan Wigan is a professor at the Copenhagen Business School. So that's available online. And for those of you who kind of want to take a deeper dive into this chart shows the evolution of a set of ideas. I was writing academically about what at that time I called the Jersey disease in the late 1990s, at a time when Nick Shaxson was a journalist for the Financial Times and The Economist covering West Africa and the oil economies, and he was writing extensively about the resource curse. And I was reading his articles thinking, that's weird, because some of the phenomena that he's talking about here are replicated here in Jersey. And we got together, I think, in 2007, and out of that collaboration came Treasure Islands. I hope you've all read Treasure Islands. That's the book that inspired the Spider's Web film, but it's a really good, deep read into Britain's tax haven economy and the emergence of tax havens into the global economy. But at the same time, we were talking about this finance curse phenomenon. We published a monograph which you can get free of charge. It's downloadable as a PDF file. And then in 2018, in November last year, we published the new book, The Finance Curse, and that went straight to the Financial Times bestsellers. So we're very pleased about that. And I'm now working on a film around that. That's it. I hope that's been of interest to you. I hope it shows you why we're at such an incredible moment. Politically in this country, we have a government which, if it forms majority government after an election, will take us down the Singapore and Thames model. And we have an opposition which will take us in an almost diametrically different development model, saying actually we want to move away from being an offshore tax haven and towards becoming a new productive economy, Green New Deal, etc., etc. I don't think we've had such an inflection point in Britain since 1945.